Hello, my name is Benjamin Zinn, and I'm going to introduce you to an investment strategy that will hopefully boost your return on your investments. I found this strategy on investopedia.org, and it's called income investing. The main theme behind this strategy is that it aims at picking companies that provide a steady income in form of dividends. When investors usually focus on investing in dividends, they pick older, more sophisticated companies that have been public for a while. Usually the companies have reached a certain size and are no longer able to sustain a higher level of growth, so they pay out their retained earnings in form of dividends. However, that's not always true, which I will show you in this presentation. Also, this strategy does not focus on stocks that pay out really high dividends. The important factor here is the dividend yield, which you can calculate by dividing the annual dividend per share divided by the share price. So we have to focus on companies that will follow a steady dividend policy and that have steadily increased their dividends over time. Also, picking a good company, you will have to have some knowledge of fundamental analysis. So I picked 3 companies, and one of them is Home Depot. Home Depot, we can see that Home Depot increased their dividends over the last 6 years. Each block represents 1 year. So I calculated the dividend payout per share, the annual dividend per share, and the dividend yield. And if we look at the dividend yield, we can see the dividend yield increased from 0.86% to 1.6%. So now let's take a look at the performance of the stock over the last 6 years. We can see the stock performed well, and it recorded a return of astonishing 369.82%. But if we factor in the dividend without reinvesting them, the return is 388.94%, almost 20% higher. So another example, we have Verizon. With Verizon, we can also see the dividend grew over the last 6 years. If we look at the dividend yield grew from 1.6% to 2%. And then if we look at the stock performance, it also the stock value also increased. It reported a return of 62.14%, and if we factor in the dividend without reinvesting them, it records a return of 77.29%, an increase of 15.15%. And then we have Johnson & Johnson. Johnson & Johnson increased their dividend since 1963, and over the last 6 years we can see the dividend yield increased from 1.87% to 2.87%, an entire percent. And if we look at their stock value, Johnson & Johnson recorded a return of 71.21%. And if we factor again the dividends in, we'll get a return of 89.67%, boosting your return on your investment of 18.46%. Another advantage of this strategy, besides boosting your returns, is that if the company's stock will decrease, investors might still come out on top if the dividend yield is greater than the loss on the return. And this was my presentation on portfolio investment strategy. I hope you can use it to boost your returns on your portfolio, but just remember, it's not about the size of the dividends. It is more important to find a company with a steady dividend policy